Property investing gets talked about a lot.
What you don't learn about is how to make money work for you. That's a big part of the game.
Today's episode is for anyone who's curious about property, but unsure where to start, wondering if they've missed the boat or tired of the noise and hype.
A lot of people can't afford property today, so surely that means they must fall. That's a common misconception.
Welcome to The Growth Concept. I'm your host, Keone Upton, and I'm on a mission to empower growth through these real conversations. Today's guest is Niro Thambipillay, founder of Investment Rise. Niro has been investing in property for over 2 decades through multiple market cycles and has helped everyday Australians invest tens of millions of dollars using data-driven long-term approaches.
What people really struggle with is the concept of debt. Vast majority of people, it's impossible to build wealth in Australia through property without using the banks and using debt.
This conversation, we break down how the property market really works, the mistakes that hold young investors back, and whether property still has a place in building long-term wealth, especially in this changing world. If you want clarity over hype and systems over shortcuts, then this episode is for you. Disclosure: this podcast is for educational purposes only and does not constitute financial or investment advice. Always do your own research and seek advice from a licensed professional before making any financial decision. With that aside, let's get into it. This is The Growth Concept. Niro Thambipillay, welcome to The Growth Concept podcast.
Mate, great to be here, Keone.
Niro, for someone tuning into this conversation that has no idea what you do or what your passion is, what is it you do and what are you passionate about right now?
Mate, I'm just the boring property guy. All I do is look at properties around the country. I look at data. I am the boring property guy. So ask me about anything to do with property and the economy. I can talk to you about it. I can talk to you about where to invest, what areas are doing well. Anything outside of that, I am clueless. So very one-dimensional, let's just say that.
Is this property game, I assume it's a passion of yours?
Look, absolutely. I'm someone who's, reveal my age here, but I've been investing now for 23 years ago when I bought my first investment property, and really just kind of did it because, I wanted to see, how to create wealth aside from having a normal 9 to 5. That was really a big thing for me. And I went against the grain a fair bit and had some successes, but also, you learned a lot along the way. I wish I could tell you my journey was flawless. I don't have a golden boy journey by any stretch of the imagination. But eventually now, I'm lucky enough that if I want to, I could probably retire tomorrow through what I've developed in property. But, people and friends and family started asking me, how have you achieved what you're doing? How come you do things differently? And started helping them and actually kind of enjoyed it. It kept my skills sharp, kept me engaged in the game. And so that's sort of how I ended up starting, the agency Investment Rise in 2016 to see if I could, make it work. And 9 years later, here we are, still going strong.
Incredible. That's amazing. So you moved to Australia as a migrant?
Correct. So my family moved here, I was 8, nearly 9. Wow. Just a young kid. Dad, being a doctor, had to go to overseas doctor. So we moved to a regional town called Griffith, if anyone knows that, but sort of halfway between Sydney and Melbourne. Kind of where I did all of my schooling and was lucky enough to, get into university. So I moved up to Sydney. That was a great few years of partying. Don't get me wrong, I had a lot of fun. I don't know how much I learned, but I had a great time. And then, kind of got into got a job and went, yeah, I'm not going to do too well here. I need to find something else. And that's sort of what started the property journey.
Why is that getting a job you realise that this isn't for you? Like, tell me about this experience or realisation that you had.
So, I mean, I guess I could, be known as a little bit headstrong at times. And so I wasn't really, I just couldn't see myself climbing the corporate ladder. That really wasn't for me. Although, I've got the degrees and the qualifications and everything else, it just didn't fit for me. Don't get me wrong, I know a lot of people have done well in that path, and I think if it suits you, it's fantastic. It just didn't suit me. I needed a bit more freedom, and I didn't know what that looked like. So I decided I'm just going to start investing in property, never having any plans of starting a business or anything of that nature. I was more just trying to get myself set up financially, and also, working a 9 to 5. Yeah, I couldn't see myself working for 40 years for someone else, and I wasn't sure what I was going to end up at the end of it, right? So
100%.
yeah, so that was the mindset that kind of got me changing direction, and has led me to where I am today.
That's amazing. So breaking down this transition for you, because for a lot of people, this transition is very daunting from coming out of school, being somewhat brainwashed to work for people for 40 years, and then transitioning to this entrepreneur investing mindset. Did you have to unlearn and relearn particular skills or mindsets to get to where you are now with your property portfolio?
Absolutely. Absolutely. You know, I mean, because I think whatever you learn at school, whatever you learn at university, you know, say what you will, what you don't learn about is how to make money work for you, right? You know, you only learn you got to work hard, you learn skills, you get a job, promotion, whatever else. Fantastic. That's a big part of the game. But until you know how to get your money to work for you, if you think you're going to work hard, pay taxes and save your way to wealth, unfortunately, you're probably in for a bit of a rude shock, and that's more true today than it was when I started a couple of decades ago. So it was definitely a case of understanding, number one, how to make money work hard. Number two, how to look at risk, being both a positive and a negative. A lot of people think risk is always bad. It's not always the case. And then learning business skills, entrepreneurial skills as I started a business, which was very new and, you know, like it is, there's no business school. I mean, I know they exist, but they're not really that practical. At least I wasn't sure they were going to be. So you kind of learn, you know, your feet to the fire, you learn on the go, you make a few mistakes, you get knocked down and you kind of get back up again.
For sure. Were your parents big into entrepreneur mindset and property as well?
Nope, is the short answer.
Nope.
My dad's a doctor, so that's what he's done, and he loves it and good at what he does, and still does it to this day. So business and entrepreneurship was definitely not something that he wasn't against, no, or they weren't against, but neither were they. So, you know, they were pushing me either. They would have probably said, they just said, go down the path that you want to. So I was very lucky that they didn't sort of set any sort of expectations on me. It's like, you know, go down the path that you want to go down. So yeah, it was very neutral from their perspective. You can't ask for too much more than that.
Yeah, definitely. Well said. Was there much resistance in the uncertainty of entrepreneurship and what that portrayed when trying to have these conversations with your parents, which went down the conventional route?
I think it was more a case of looking at it from a money perspective and a security perspective, which is what almost any parent will ask you, right? So it was really a case of, well, what happens if this fails? Have you got a backup plan? You know, have you considered the risks of this? And, you know, what will, and all those sorts of things, which are actually really good questions to ask. I think, you know, entrepreneurship today is very much glamorized, and, you know, all the successes are out there. And yes, there are plenty of people who've made it, but there's also a lot of dark times and rocky roads. Right? And so if you don't have a plan for how to handle those, and if you're not going to expect them, if you think it's all going to be roses, you know, I think entrepreneurship will teach you some pretty big life lessons. And so some of the questions I was asked at that time was really about sort of saying, really, what's the backup plan? Right? Now, I wish I'd told you. I listened. I didn't have a backup plan. And then you just kind of, you kind of jump out the window and make the plan as you go. And so that's kind of what I did. And yeah, hard knocks and whatnot, but yeah, you kind of learn and grow. And I kind of, really love being a business owner today and being an investor and helping people. And that's no way I would ever go back to where I used to be.
100%. Do you mind me asking, how many properties do you have?
So it's a common question people ask me, and they're surprised because I know there's a lot of hype online about, 20 properties, 30 properties or whatever else. That's too much paperwork for me. I want to do it the easy way, almost a lazy way. So, I never really have owned, I don't think, any more than 6 or 7 properties at any one time, which, okay, I know that's way more than the average person. I get that, but it's not what you see online. And the reason is because if done the way I kind of like to help people do it, you don't need that many properties, right? You can consolidate your properties, you can build wealth, because every property comes with its own headaches, own paperwork and whatever else. And if you've got 20, 30 properties, you're probably employing someone to do it for you, create a full-time job, whatever. It's not the kind of passive wealth strategy that I wanted for myself or what I advocate for clients either.
100%. So with all this being said, what is your mission right now as we speak?
My mission right now would be to help as many people as I can create financial certainty for themselves. And I use that word quite deliberately because I know everyone talks about financial abundance or wealth or financial freedom. all very, very nice. But ultimately, I know from having done this now, the business has been going since 2016, what clients ultimately want is to be able to go to bed at night knowing that what they've got in place will hold them in good stead in the future, whatever that is, 10 years, 15 years, 20 years. And once they have financial certainty, then they've got more options. Then they can choose, do they still keep working the job that they do? Do they change careers? Do they keep working but reduce their hours? Whatever they want to do. But it's about helping people have financial certainty. And for me, property, the reason why I only work with people who want to invest in property is because I'm not somebody who gets enamored by, look how beautiful that property is or whatever. I really couldn't care less. I'm more interested in what it could do for you, right? In terms of building wealth, giving you passive income at some point in the future, all those sorts of things. I like those results, not how pretty a property is.
Right, okay. So for a lot of your clients starting out and your own journey of buying your first investment property 2 decades ago, what was that process like mentally for you? Was it scary? Like, what story or underlying emotions were you feeling at this time?
Yeah. So when I bought my first property, this is before Facebook, right? A world that most people don't realize, right? So it didn't exist, I don't even think realestate.com.au existed, right? So this whole concept of buying properties, especially in areas you didn't live in, really wasn't done. Okay, and so I was living in Sydney, and with kind of my price point, even at that time, I couldn't really afford a house in Sydney, and so most people said, look, you just go buy a 2-bedroom unit in Western Sydney, for example. This is the done thing. Now, one of my degrees is I've got an economics degree, so I understand supply and demand, and one of the key questions I kept asking is, if I want to build wealth, I want to buy properties in areas where there's strong demand, but not enough supply, because that's what makes prices rise. And when I'm buying a unit, especially back then, it was so easy for developers to build new towers, build high rises. So I kept asking the question, why would I do that? What's going to make prices rise? And the concept, the answer I kept getting was, no, you're young, you just do this. This is the way it's done, right? Now being a little bit headstrong, I was like, if it doesn't make sense for you, I'm not going to do it. So I kind of then, did a little bit more research and study and whatever. And when I, living in Sydney, when I bought my first property, totally unsight unseen, all the way over in Western Australia, right? Wow. Okay, so other side of the country. Now, a lot of people who knew me thought I was bonkers, right? Thought I lost my marbles. Fair play to them, right? I was probably, as I said, headstrong is probably why I did it. But to their surprise, and probably somewhat to mine, 18 months later, I doubled my money, okay? And now, I wouldn't tell you that's totally scientific. There was a lot of dumb luck. I'll be very upfront around that. But what it did show me and illustrate to me is that property investing done right could give you some amazing results, right? And so, going back to your question around what was the emotion, a lot of fear, a lot of uncertainty, right? But what sort of got me moving forwards was like, well, what happens if I don't do this, right? I was, again, in my 20s at the time. When I started, I was like, I'm living at home. I was lucky enough to live at home. I was like, all right, and I didn't really care about losing money or whatnot. I just want to see, can I make it work? So starting young helped me. And that's why I encourage a lot of people, if they are young enough, to start early. But if they're not, and that's why a lot of people then come to me for help, because they can't afford to make some of the mistakes that a lot of people do make around property investing. Right.
Okay, so during your first property, you had some dumb luck.
Yeah, I'd call it that.
Yeah, and you doubled your money within 18 months, which is incredible. Congratulations. But on the backbone of this, what metrics were you weighing up in this decision? Because, you said you had uncertainty, fear, self-doubt. But what metrics were you looking at to be like, okay, well, this is something I'm going to do? Or did you just send it?
There were some metrics. There was some science to it. I could sort of track, people are moving to an area. I sort of understood that, ultimately, this is going to sound really basic, but properties prices rise in value because more people want them and more people, want to live in those areas than available properties. All right, it's kind of made it as simple as that. So I was looking at that sort of analysis. Obviously, what could I afford for my price point? What was the investment in the area that could also make the area grow and get people coming into the area? So these were some of the simple, basic metrics that I was doing. It's kind of a lot better now, 20 years later, but at the time it was just very high level. there would have been probably less than 5 metrics to be frank. If I had to think about it, and that's why I'd call it dumb luck, because I couldn't. The thing I say it was dumb luck. I couldn't replicate it, right, for a while, right. I kind of then did it and went, oh, this didn't work. So I had a few, mistakes along the way, and I'm someone who's can be quite analytical, and kind of went, all right, well, if that worked, if property A worked, but property B didn't, what was different? Right, and I started to work out some of the key factors and recurring patterns, and I went, okay. And so that's sort of how I learned what I do. And so it's really not based on reading some books. It's based on lived experience.
100%. You were saying that this first property did well and you couldn't replicate that for a while. And you were breaking down the metrics of, okay, property A performed really well because of X, Y. Affordability was good. The supply and demand was good. It was in a high public transport area. But property B, would you say flopped or didn't perform as well?
Some of them, look, I did lose money on a couple of investments. At least, I bought them and they did fall in value. So anyone says property doesn't fall in value, it can. I'm living proof of that, so it can. Others, went flat, but others, they rose. But if you buy something for, say in today's dollars, for $600,000, and it rises in 3 years' time to be 630, but you could have bought another area at 600K and that property's worth 800K, you haven't really made money, right? Because, you've actually lost out. So I was kind of getting those sort of B, C, D grade investments. So what was I'm missing? Had to kind of fine tune that a little bit. And now, not just myself, but my clients, we got very repeatable success because the metrics now are very much ironed out. And that's kind of, again, it just takes time to really get to that level.
What were you missing in this process?
Yep. The biggest thing I was missing was owner-occupier demand, right? So, and I think it's very relevant today because I see a lot of people, they are chasing investor hotspots. This is the top 5 best areas to invest in Australia, the free websites or whatever else you'll see online. And they're tracking like where their friends are going or wherever else. But what I realize is for long-term demand, you need to have people who want to move and live in this area, right? Sounds so straightforward, but that's what I was really missing. And kind of once I understood that, then I realized, okay, it's not just capital cities that are going to rise in value. A lot of regional areas will rise in value because if you have 100 people who want to move to an area and live there, and there's only, 60 houses, well, guess what? There's more demand than supply. Price is going to go one way, right?
Yeah.
So yeah, that's what I was missing.
So owner-occupied demand, that's simply looking at, is this area an area I see people wanting to live in? Is it as simple as that? Or is there
other people wanting to live there? So it's not just I see, are they doing it right now? Because you can't predict, all right, what's going on in the future. So I need to see it right now. Are people wanting to live here? Are there more people coming to want to live in this area? How many properties are for sale? How much are they building? And then you start looking at, well, what are the amenities here? Are they building some new schools here? Shops? Those sorts of what I call livability-based amenities that will attract young families to these areas, right? That's kind of where I look at it, which is why a lot of areas I won't invest in or help clients invest in because they don't have that demand, which means while you might get some short-term price growth, yes, because investors are pumping up prices, it doesn't last long-term. And that was a big learning that I had to follow and recover from. And that's why today I avoid most of these so-called investor hotspots like the plague, because you are putting yourself at a big risk.
Investor hotspots. Give me a bit of an understanding about this. Have you struggled with that FOMO aspect of these hotspots?
Good question. I used to, yes. You kind of see, an area rising in value. You see everyone talking about it and you think, oh, you should jump in. But unless you're one of the early ones to jump in, you're probably jumping in at the time the early adopters are jumping out. Right, so you're buying what they're kind of offloading, which isn't great. So I've definitely struggled with that in the past, personally. Today, if somebody reaches out to me and asks me to invest in an area or help them invest in an area that I don't believe in, I just won't take the client on, right? Because it's better for. I really want to make sure that any property I help a client buy, I truly believe in. And so that means it has to be what I call an owner-occupier hotspot primarily, as opposed to an investor hotspot. So the difference is look at who is doing the buying. If the majority of people buying are investors, I probably won't buy there. In fact, almost certainly won't buy there. if the majority of people buying are owner-occupiers, people buying to move and live in an area, then it's worth considering.
Why is that?
Purely because, if somebody buys a property and is going to live there, they're going to be there for years. They've decided that's probably where they're going to, stay for quite some time, right? It is actually as simple as that. So they're not going to sell in 6 months' time, right? Whereas investors, often a lot of them are chasing very speculative returns. So buy here, sell when they've made a gain and jump out. Or they're chasing higher rental yields or whatever else, which are all good in the short term. But in the long term, it all levels out. The classic is a lot of mining towns, for example. They can rise in value significantly. You can get great positive cash flow. They all look good. But when the mining industry goes through a downturn, nobody wants to live there anymore.
Right. All of this information so far doesn't sound like rocket science, which is pretty funny because it seems to be overcomplicated in the media.
Mm-hmm.
If someone's listening to this age 17 to 30 to even 50 wanting to get into property, what are some common misconceptions you personally see with your clients?
Yeah. There's a few big ones. One of them is that people think they know an area, right? And when they say they know an area, what that means they're familiar with it. So they'll talk to you about how good the cafes are, maybe the schools are, all that sort of stuff. But that got no correlation to price growth, right? For example, and the big easy example is Melbourne. Melbourne prices from 2017 pretty much fell until the end of 2024, right? Now, there were a lot of so-called good areas there, or areas people would have liked, but that's not enough, right? You need to be tracking some of the other data factors that we've been speaking about. So just because an area is familiar doesn't mean it's great. If the next big one is, if you can't afford a house in an area, buy an apartment in that area, right? Because a lot of people think if a house doesn't grow in value, then just buy the apartment. There are too many areas, especially in our more expensive capital cities, namely Sydney and Melbourne, where I can name individual suburbs where house prices has maybe doubled in value, while apartments have stayed the same or even fallen in those very same suburbs.
Why do you think that's the case? Because, me thinking out loud right now, a house, yes, you do have a bigger block, more privacy if that's your thing, but apartment, you still get your own place. It may not be as big, but you still have the accessibility to services, the cafes, the pubs if you're in Australia. Why do you think the apartment sector doesn't perform as good as the residential sector?
Yeah. So again, it goes back to what I was saying earlier on, is that the misconception, if you can't buy a house in a suburb, buy an apartment. Now, if the average buyer in that suburb, as in an owner-occupier, someone wants to live there, doesn't want to live in a unit, then you're buying something that nobody wants to actually live in, right? Okay. So, for example, if you take some of the coastal suburbs, this doesn't always apply, right? Say in Sydney, northern beaches, apartments have risen significantly, and so do houses. It works, okay? If you go to, say, some of the northwest suburbs, house prices have risen significantly, but no one's moving like an hour away from the CBD to really want to live in an apartment, at least right now. It may change in the future, and I'm always tracking that, but right now that's not what people are aspiring to. So therefore, you've got to be looking at it from an owner-occupier. So even though we're buying as investors, or my clients are, you want to be looking at it from a perspective of, well, who actually wants to live in here? Who am I going to be selling to in the future, right? Because if somebody doesn't want to actually buy that property to live in themselves, the demand from a future price growth perspective, it's almost always going to be limited.
Why do you think that this is such a big misconception people have developed? At what point do you think this was educated in society?
I think it may have worked, previous generations ago, parents' generation, that sort of stuff, because there wasn't that much development happening, right? So if you couldn't buy a house, you bought an apartment. The only problem is, what people didn't realize is that if apartments do rise, when they do rise a certain amount, there becomes enough profit margin in it for a developer to come in and build up another tower. Now, all of a sudden, that means you are increasing supply of something. Whenever you increase the supply, whether it's houses, whether it's concert tickets, whether it's bananas, prices drop, right? But when supply is constrained, again, we always hear in the economy, something happened from a weather perspective and bananas prices have gone up. It's not because anything happened from a demand perspective, just supply has fallen, right? So whenever you have that kind of concept of supply can be increased, it just stops price growth. Or if nobody wants to buy those things, that's where the problems happen.
Interesting. So at the moment, we're seeing Perth property prices all-time high, Sydney property prices ridiculously high, same with everywhere else.
Yes.
For someone who doesn't have enough cash flow or capital to get in the door, would there be a leeway that a apartment would be a good place to start to get your foot in the door? Or do you feel, keeping that in mind, apartments aren't the best investment depending on your strategy?
It's always a scary question to answer because I don't want anyone who listens to kind of take a blanket approach here. Ultimately, I think houses in areas where people want to live will outperform apartments, right? Now, if you can't afford apartments, if you can't afford a house, even in regional markets, right? We're not talking capital cities necessarily, but look at regional markets, then it may actually be worth your while to, it's going to sound controversial, but maybe not look at property, because the last thing you want to do is say, I bought this unit for, I don't know, 700 grand in 2026, and then here comes, 5 years later, it's still not worth any more than they paid for it, right? Because there are a lot of on costs that come with buying, properties, like stamp duties and everything else. So, but if you can do your research, and if you can buy an apartment in what's called a low set environment, so where it means they're not building massive towers, there's no more land for them to build on, and the price works, then maybe that could work for you, right? But you just can't say, this brand new shiny off the plan thing where it's one of 500, that's going to make me money. Unlikely, right? Good so point. You've just got to make sure that you're looking at the right dwelling type. But if someone's asking for a general rule, sticking to houses in locations where people want to live, it's going to give you the better growth.
The biggest misconceptions you've said is the misconception of people, quote unquote, knowing their area, knowing the best places, and as a result, that's going to bring up the prices, as well as the misconception of if you can't afford a property, get an apartment in that area. Yep. Are they the two main and only misconceptions you see in your clientele as well as in society, or does it change based on upbringing, nationality, age?
All of that, upbringing, what they've been told, how they've been educated, what their background is, all of that matters. So, for example, there are people out there who will say you don't buy a property unless it can cash flow or give you positive cash flow, right? That's something someone recently asked me is, why would I buy a property that's going to be negatively cash flow, right? Now, again, because especially if a lot of stuff online is US-centric and US-based, where you can get positive cash flow, no dramas. But in Australia, that doesn't really exist, at least not without trading off capital growth, right? Because what I always tell people, what's the point of buying something for, say, 500 grand that gives you, $100 a week, but in 10 years' time is also still worth 500 grand, right? You're not going to be able to get wealthy off that. So what you really want to be looking at is looking at areas where, if there's negative cash flow today, fine, can you afford that? That's the first thing. I know it sounds obvious, but a lot of people don't consider that. So look at that, number one. Then look at saying, well, is the growth likely to offset the negative cash flow? So you're building your wealth. And then thirdly, is there sufficient rental demand so that rents are going to keep rising? So whatever that negative cash flow is per month will reduce, right? So if you want to do the ultra slow way, you could buy one property, and let's just put some numbers around it. Let's say it costs you $2,000 a month to hold, okay? And let's say that you decide that you don't want to spend any more than that, and so you buy this one property, maybe you own it, again, just making this example, it takes you 5 years, and it takes you 5 years for $2,000 a month to go to zero, okay? Then at that point, and meanwhile the property may have risen 60-80% by that stage, you could then go buy a second property, again maybe costing you $2,000 a month, but if property one is costing you zero, and property two is costing you $2,000 a month, you've essentially now got two properties that cost you the same as that one property when you first bought it 5 years ago in this example, right? So I have clients who take that very steady, slow approach because they've got to manage their cash flow, right? So that's always a way to do it. Now, of course, there are strategies you can do to enhance cash flow and everything else as things get more advanced. But at a very fundamental level, one of the biggest conceptions is positive cash flow is the way to build wealth. You can build a portfolio that's going to give you passive income and positive cash flow in Australia. However, it's not a direct process of targeting positive cash flow properties. It's actually a counterintuitive process of targeting properties for capital growth first that will over time give you rental growth and then, give you that positive cash flow that you're after.
Interesting. So I remember reading this in a few money books. There's three different types of cash flow: negative, neutral, and positive.
Yep.
Negatives, obviously, you're losing money on that investment at first. Neutral is you're not losing or making money, and positive is you're making money on that asset straight away.
Correct.
This is interesting because seeing the rise in land prices in particular areas around Perth, when you do buy property, you sometimes in positive cash flow straight away. In your investments that you've seen them perform, with the negative cash flow at first, do you think that makes people steer away from it, or is there some common fears or mindset barriers that you see that people need to adapt to push through? Okay, well, it's negative cash flow today, but tomorrow it may be neutral. How do we go about weighing up this risk?
Good question. And I think even before that, there's one step a lot of people really struggle with is the concept of debt. Right? Because, if you own your own home, maybe you paid it off, or maybe you just anti-debt, and now you've got to buy an investment property for whatever. Average house price in Australia is over $1 million, mind you, so it's not cheap. You're going to incur some kind of debt, right? And if you're uncomfortable with that, that's going to hold you back first and foremost, right? Virtually for vast majority of people, it's impossible to build wealth in Australia through property without using the banks and using debt, right? So that is often because of debt, you have interest on that debt. That's how the banks make their money, right? So that's why you're going to have a negative cash flow, okay? So therefore, yes, there is a mindset around, okay, I need to take on more debt, and I'm going to be not taxing, but putting an extra load on my cash flow, my lifestyle income, whatever you want to call it. Is it worth it, right? That's the question people have to ask themselves. And really the question is, well, if you can buy a property that's going to, maybe double in value in 10 years' time, for example, you just got to do the numbers, right? So, and work out, is that worth it? Also, it's costing me X today, but is X going to be pretty much zero over the course of that time period? So how long am I holding it for? How much is it costing me? How much am I going to make from it? It really becomes a numbers game in terms of if you should buy a property. And then you're looking to find, well, where can I find property that's going to match that sort of anticipated numbers profile that I've just outlined.
Right. So with that being said, with the people taking out $1 million plus mortgages these days, and with people breaking down the numbers, it works out to be like crazy numbers, like $4,000 a month potentially. Is there a ratio you've found that income coming in versus this is based on interest rates, but money we should be typically borrowing based on the income to make sure we're not losing heaps or type thing?
Look, not really, and the answer is because it depends on everyone's incomes, right? But also not just incomes, what their lifestyle is, right? If you got a family of 4 kids going to private school, for example, you're going to have a different income expenditure ratio versus maybe 2 people who don't have kids, for example, right? So it does take into account your personal situation. So that's why I always say everyone who's looking to buy an investment property has to work out their own cash flow profile, work out how much they can afford to spend. And again, the things of ratios, percentages, yields, all that, it can complicate things. So I just want to know, how much could you afford to spend on a month-to-month basis on a property without affecting your lifestyle? If you can keep it that simple, right? And you're high level, you can, if you really want to be, keep it simple, look at your income, look at what you spend on your credit card, what's left, and your rent. Right, and then what's left, right, or what you pay in your mortgage. So you can keep it high level, but you need to have some sense of what you can afford. Otherwise, you're never going to know if you're buying a good deal or not for you.
100%. Other than looking at the area affordability, supply and demand of a sector, what else should we be looking at when we're evaluating a property? Yep. Especially with the environmental concerns in this day and age as well.
Absolutely right. And I think with that whole question, the key thing comes down to how well do you know an area? And I'm talking about where the cafes are, whatever else. What I'm asking is, do you know who is buying property in this area? Okay, right? So to give an example, if we look at, say, Brisbane versus Sydney, Brisbane prices have nearly pretty much doubled in the last 5 years or so, right? Now, there are a lot of people out there who'll tell you the Brisbane market has to fall because it's risen so much, it has to fall. And they'll give you all these fancy investment metrics, right? I kind of keep it simple. I look at, well, who's buying? And the average person buying in Brisbane is someone moving up from Sydney, where in Sydney, the median house price is 1.75 million, but that's median. If you want to buy anywhere near the city, it's got a 2 in front of it, right? It's 2 million plus, okay? Now, someone's going, if I can buy half an hour from the city for $1 million in Brisbane, or buy the same thing half an hour from the city and $2 million in Sydney, Brisbane's still cheap, right? So therefore, when you look at who's doing the buying, that's what you need to understand to then work out what type of property to buy, what locations to buy in, right? You've just got to track the activity in the area. So environmental concerns, yes. Do the others in this area have environmental concerns? Is that determining what they're buying? For example, should you be close to a train line? Well, depends. Do others want to be close to a train line? In Sydney, yes. In some parts of Queensland, they couldn't care less, right? Okay. So these are the sorts of things you want to be analysing, and that's when, I guess, as simple as we're trying to keep this, you've got to really drill down into the nitty-gritty.
Wow, okay. So with that being said, according to the ABC and Nine and heaps of other sources nowadays, 1 in 10 properties are on set to be uninsurable by 2035 due to climate risk, natural disasters.
Yep.
When you hear 1 in 10 properties could be uninsurable by 2025, what goes through your mind? Is it still so optimistic, or is there some other emotions going against that?
I love reading these articles, but I kind of think about, if someone's living close to the beach and has been there for 20 years, the fact that they can't get insurance, is that going to matter to them? Probably not. They're so used to it, right? That's what they're used to, okay? So what you'll probably see, though, is that as the next iteration of buyers, shall we say, are more aware of these concepts than perhaps the current buyers are, it may reduce demand on those properties. And we're really talking about them, 1 in 10. You're talking about the coastal fringes, essentially, right? Okay? So you might see lowering demand, which might mitigate some of the growth there, okay? But they're already so expensive, right? So it's not as if capital growth slowing down is going to be a bad thing. And I say capital growth slowing down. I'm not talking about prices crashing at all, because ultimately everyone has different levels of risk. And some people will go, well, it's my place, I want to live in it, and I don't care what the insurance guy says, I like this location. The end, right? Someone makes a killing in business, decides they want to buy a trophy property right by the water, and they think it's not going to be affected for 35 years, and they'll be too old to care by that stage. So be it. So it is going to it'll be interesting to see the impact from a capital growth perspective, but I still believe that there'll be enough buyers out there who want that type of lifestyle and who'll be able to afford it, that will keep prices still fairly elevated in those areas where there will be those, like you said, environmental concerns.
Do you see the fact that, coastal lines, we typically don't have, I shouldn't be saying this, but tsunamis and stuff in Australia? Touch wood.
Yes.
But it's what the LA fires taught us is that no city is safe.
Sure. Yep.
Do you think that the property market, when these insurance companies and brokers start rolling out these restrictions on people getting in the market and property investors having a well-established portfolio, no longer being able to get that security net on their portfolio, there's going to be somewhat a mass sell-off?
Unlikely, because in this country we have such a supply shortage of properties, right?
Yeah.
People still want somewhere to live. So if we were in a balanced market, so where there were roughly similar number of buyers, similar number of sellers, then maybe. But when you have such a shortage, people will, especially in Australia, it's still the great Australian dream to have a home, right? That hasn't changed no matter how much prices have risen. So it's always going to keep a floor under property prices while we have all the underlying issues that we have in terms of supply shortages, not the ability to not build enough homes, all of that. So I can't see a mass sell-off happening. We've had enough financial crises, on a global scale, and the Australian property market has probably one of the most robust globally. Whether that's good or bad, it kind of always depends on what perspective you're taking, but that's just the fact. So, yeah, I don't see much happening that would be unique to Australia that's going to cause a mass sell-off.
For someone who is looking to get into the property market and with having these stats and news articles that are coming out, if you were starting from nothing again today, would you still steer towards your property approach?
The short answer to that question is yes, because if I lost everything today, I'd be able to quickly analyze, again, which areas are likely to grow, repeating everything that we've already spoken about, and I would go in even more aggressively as we talk about this at the start of 2026. I'd be even more aggressive, because with the crises that we have in terms of not enough properties and all the various incentives and schemes are out there to help people buy, it's all it's doing is increasing demand while supply is falling away, right? So again, fundamental economics tells me that prices will rise. Now, they're not going to rise everywhere, right? So even though the median house price in Australia will keep going up, you're going to see some areas rise, some areas not. And so I'll be targeting those areas where prices are likely to rise and rise deeply, and I'd be even more aggressive than I was when I first started, because if I lost everything financially, I've still got 20 years of experience, right, behind me. And 100%. So that's where I would, like some clients that come to me and they want to be aggressive, but they don't want to just buy blindly. I can definitely help them do that, right? Others will start very conservatively because it's their first property. They could buy 5 or 6, but they want to start with 1. Makes perfect sense. See how it goes. And then 1, the next time they'll buy 2, the next time they'll buy 3, right? But it takes experience to have that confidence that I guess I'm able to share here.
How long do you feel someone needs to get a similar experience as you to make these crucial judgments on the property market?
Okay, so that's a good question. There's 2 ways to do it. Number 1, you either do it through experience, so you buy a property, see what happens. That's going to give you a great sort of personal experience. Oh, this is what happens. But again, the challenge with that is you go, okay, it worked in that area. Is it going to work in another area as well, right? So therefore, that experience could be a bit slow, but this really is kind of analyzing, like I said, I'm the boring property guy because I'm analyzing movements all the time, right? I'm always looking to see what's going on, why are these, and the question I'm always asking, why are these areas rising? I don't have properties in every area around Australia. It's impossible for anyone to do that. So because I spend so much time on it, I'm able to probably analyze a market very quickly and build up that knowledge bank. But it's going to take someone, I think, probably at least 12 months to gain a level of comfort and experience that they have sort of been able to work out which areas are likely to rise, and more importantly, why. I always ask this question. Someone asks me, this area is going to rise in value, and I'll say, why? You know how often their response is stunned silence? Because it has to. I'm like, what does that mean?
It's got a pub down the road, though.
Yeah, exactly. Right? It just makes zero sense. So you've got to, if you can confidently answer the question, why is this area going to rise? And that's when you have that level of experience or confidence. And it is learnable, and nobody's born out of the womb with these sort of skills. It's learnable. The question I often ask people is, do you have the time to learn it? And it takes you 12 months, 24 months, sure. How much might property prices rise while you're learning, right? Is this something where you get an expert on board to help you so you can build that and learn along the way? A lot of our clients are learning along the way and they've built a property portfolio, but because we've guided them, they've not missed out, because there's a cost of a learning curve. A learning curve takes time, right? And if this was a flat market or not rising the way it is, and as I expect as we get into 2026, then you'd be fine. But there's a cost of time, a cost of waiting.
Right, okay. So with all of this being said, for the young investor today, it's not too late, essentially.
No. Look, if somebody can afford to buy property, the 2 biggest mistakes they can make is wait for a better time, whatever that might look like, right? Or just buy blindly without really doing their research. Okay? those are the two things that I would say. A common question though when I say this, people say, but what about affordability, right? What about the fact that a lot of people can't afford property today? So surely that means they must fall. That's a common misconception a lot of people have, right? Now, my answer to that is very simple. If you have 10 people who are looking to buy property and there are only 6 properties available, keeping it simple as possible, that means 6 people get properties, 4 miss out, right? It does not matter about the affordability of all 10. All that matters is the affordability of the top 6, right? Okay. Now, that's a sad reality. If you're on the bottom 4, that's where we have a crisis, right? It's not great. But let's not mistake the fact that that's not great with the fact that prices are going to fall. Nuh-uh, right? We just don't have enough. So fundamental economics shows that the supply shortages have a much bigger impact on the property market than the average affordability, because affordability doesn't matter if there aren't enough properties available.
Wow, such a good point. Do you think for someone wanting to fast track their property growth, this episode and all the information we've shared will allow them to fast track this?
I certainly hope so. Because really, I've tried to keep it as simple as possible. Look, I live and breathe this stuff every day, right? This is what I do. So what I want is the listener to take away from this is that it's doable, but some of the stuff that you're probably seeing online isn't the stuff to be looking at. Keep it simple. Do people want to move to this area, right? Start there, right? Look at the number of properties for sale. Look at how much they're building. More people looking to move here than available properties. And you can work that out by either attending a few auctions or speaking to local agents to work out how many offers are being made on properties. If there's more offers being made than properties available, demand is higher than supply, right? But it takes groundwork. It takes effort. And there are how many suburbs? How much are you analyzing, right? So it's doable, but keep it as simple as possible and you can make it happen.
Such a great point. We have 3 questions from the listeners for this episode. Awesome. This would be kind of like a rapid fire question. So if you can answer these questions super simple in 1 sentence, try to get there. That would be incredible. Okay. One habit that has helped you most as an investor?
Being able to analyze numbers and demographic movements.
One metric every investor should understand.
Owner-Occupier Demand versus supply of properties.
Love that. One thing beginners should stop doing immediately with property investing.
Worrying about how expensive properties are and just getting in as soon as they can possibly afford.
Niro, that was incredible. A question from the last guest that I interviewed was this. If you could wave a magic wand, what is one thing you would change?
About anything?
Anything.
Oh, wow. Okay. I wish I could have bought more properties earlier, to be honest.
And Bitcoin.
Exactly, and Bitcoin for sure. Really, because it's, everything I'm sharing and why I'm so passionate about helping people is because while I've done well, yes, I look back and say how much missed opportunity I missed out on, right? And if I can help others not miss out on that opportunity, then my experience has value out there to help others.
If you could go back to your younger self with the knowledge and wisdom you have now, other than just buy more properties and Bitcoin, what would you tell yourself and why?
Number one, I think I would tell them, look, it's going to be okay. You don't have to stress. Things are difficult, and they're difficult today. They were difficult back then. You're going to be fine, and just focus on what's most important and the fundamentals, right? There's so many shiny silver bullets and different distractions or whatever else. Keep it simple. If you're going down the path of property, focus on the fundamentals, build a portfolio at a rate that you're comfortable with, and kind of chill. You don't need to be a multimillionaire by the time you're 30 or 25 or whatever else that I was trying to do. That time comes and goes pretty quickly, and you kind of go, what was I in a hurry for? Take it easy. Life is probably a lot longer than most people realize.
Good point. Did you rush the process a bit when you first started?
Definitely. I rushed it. So while I say I would have bought more properties, yes. However, I would have bought more properties with a long-term view to building wealth, as opposed to, dare I say it, get rich quick. Doing stuff that, shortcuts, buying areas that I could buy now and I could time the market perfectly and get out and make those short-term gains and look like a hero to, I don't know who, nobody's watching me. Right? So that's what I mean by I would have slowed down a bit, stayed a bit more focused. I mean, you can still build tremendous wealth. You can afford to buy one property every 3 years, right? You can still, over 10 years, at 3-4 properties, let them go, you're going to build significant wealth. So it's not about even buying a property every month, even every year. You can do this more consistently and slowly. Just stay focused.
Did you get distracted by material possessions, like driving that Aston Martin?
I think so. And I probably did things to get certain things like, the fancy car or whatever else to look good to others. I didn't realize nobody cared. It's the first thing. They don't. But all these things come with a cost, right? And I wasn't ready for that. So yeah, getting distracted by shiny object syndrome, whether it's the new toy, the new whatever, rather than staying focused. Yeah, I would definitely say that I could have built a lot more wealth had I just stuck true to the fundamentals rather than trying to take the shortcuts.
Niro, that was incredible. What question do you want to leave for the next guest I interview on the podcast, not knowing who they are, what business they're in, or what story they tell?
Yeah, absolutely. I think I would love the same question you asked me, is if they could go back and talk to their younger selves, what advice would they give themselves about that would maybe have changed the direction of their lives?
Niro, thank you so much for this conversation. I absolutely love your energy and the wisdom that you shared with me today. I'm so grateful for this opportunity and wishing nothing but success and happiness your way.
It's been a pleasure, Keone. Thank you so much.
Thank you. All of your links are linked in the show notes below. Check it out. Thank you.
Appreciate it. Thanks, mate.